if we're ever going to get this inflation thing under control, we need commodity prices to come down, way down. Fortunately, many of these things have already started rolling over. I've been talking about that lately, and there's a good chance this is just the beginning. And that's why tonight we're going off the chart with the help of Carley Garner. She's that brilliant technician who's the co-founder of Carley Trading, the author of Higher Probability Commodity Trading, and she is our resident commodities expert, and she's been nailing them. In her view, commodity rallies are inherently unstable. We've had a multi-year bull market here, but she thinks that's produced a ton of complacency. According to history, commodity rallies tend to be incredibly compelling, but they're also temporary, almost by definition. See, if you're buying copper or oil or steel or wheat, it's not like you're investing in a stock. Commodities don't pay dividends. They don't have buybacks. As Garner sees it, that makes them very unattractive to longer-term investors. Instead, they're a magnet for shorter-term traders. You know I don't like shorter-term trading. That's why historically commodity markets tend to be extremely volatile. And when a commodity boom turns into a commodity bust, well, it can take newer players by surprise. So now, let's go into this. Take a look at the Goldman Sachs Commodity Index. This is comprised of 24 different exchange-traded futures contracts across 5 sectors over the last 50 years. Interesting picture. Garner points out that commodity prices tend to trade sideways over the long run. Through the 70s, 80s, and 90s, you had a pretty tight trading range. Then the commodity index moved up to new range in the 2000s, but that's where it stayed. Even after the recent commodity boom, this index is basically just back to where it was trading in the last boom before the financial crisis hit. That's why Garner's a big believer in the idea that commodity rallies almost never have staying power. There are powerful deflationary forces here, like the adoption of new technology that makes it cheaper to farm, or, Deere's got that, or produce oil and mines for metals. We've seen that from Caterpillar, from Schlumberger. In 2007, we thought the world was running out of fossil fuels. By 2014, the rise of fracking meant we had a massive oil and gas glut. Just as important, when commodities get too expensive, the miners and farmers and drillers tend to increase production. As more supply comes online, prices come back down, especially if the Fed hits the brakes on the economy to tamp down or demand, as they're doing exactly right now. So for Garner, every commodity rally is basically a commodity collapse waiting to happen. I'm going to repeat that. Commodity rally is a commodity collapse waiting to happen. Now I want you to zoom in the last 20 years of action in the Goldman Sachs Commodity Index. You get a better sense of what we're talking about here. There's a boom, then a bust, then a boom, then a bust. Pretty amazing, isn't it? Look at this. These changes of trajectory often coincide with the Federal Reserve's behavior. That makes sense. It's about tight money and loose money. And hey, if you want to say this time is different, Garner reminds us that every one of these past commodity bull markets seemed incredibly compelling at the time. They were super cycles. In 2008, there were tons of people who thought gas prices would keep going up forever until the whole economy fell off a cliff. Oil peaked at just under 150 in 2008. If someone came on here when it was 150 and said, you know what, it's headed to 30, they would have been laughed off the air, yet that's exactly what happened. In 2011, we had an oil and agricultural boom. That was fueled by the Arab Spring, a series of uprisings and protests against oppressive regimes in the Middle East and North Africa. Those uprisings caused shortages. It felt like higher commodity prices were the new normal. But that was the peak. We were actually headed into a decade-long bear market in commodities. Just incredible. Now, you might think it's crazy to bet against oil here. And I got to tell you, I am partial to oil, but, given that Russia's invasion of Ukraine has taken a ton of supply off the Western market. However, you could have said the same thing about Libya in 2011. You would have been dead wrong, even as Libya remains a failed state. In short, Garner thinks that these commodity booms tend to seem a lot more sustainable than they really are. So why don't we talk about individual commodities, because I know you care about them. This is a monthly chart of West Texas Intermediate crude futures. Now we're going back 30 years, okay? Garner points out that oil was in a bad place for years before the pandemic. If not for COVID and the war in Ukraine, it would probably still be in a bad place. Look where it was. I mean, this thing was just awful. Once the supply shock wears off, Garner expects we're going to be left with oil prices closer to the long-run equilibrium, which would put it right back here. And by the way, that's what the futures contracts say. If you look out in the out years, it's a level that's acted as a magnet for pricing for the last 20 years. Of course, that's long-term. She's not saying it will happen immediately, and I know that because I tell her that we have a bunch of oils for the charitable trust. She's not saying it's going to happen immediately. Possibly oil could have one more burst upside. She just needs you to understand that commodities can go down as swiftly as they go up. Now, you might think her $50 to $75 price for oil sounds crazy. given that governments around the world have turned very hostile on fossil fuels. Garner doesn't think that will last. It's easy for politicians to be pro-environment when oil's cheap. But when gas prices go through the roof, that's a very different story. Plus, there's Russia. It's not like their oil disappeared. They're just selling it to China and India instead of Europe. Sooner or later, Garner thinks the energy market will adjust to the new distribution. Bad news if you own the oil stocks, and I know that, and it's worrisome to me. But very good news for cash-strapped consumers. Next, food is the other big inflation component here that you talk about. So take a gander at the monthly chart of corn prices going back to the 60s. While corn prices have increased gradually over the decades, Garner points out that it's like a staircase. Corn usually trades in a tight range. Then once every 10 or 20 years, it moves up a step. Since 2007, she says corn's mostly traded between $3 and $4.60, with the exception of some temporary spikes. Could the recent corn rally represent another step higher? Garner says it's possible. But even if that happens, she'd expect the new floor to be around $5. So corn at $7 to $8 a bushel simply isn't going to be the new normal. Why? Because the longer corn prices stay high, the more money farmers will spend boosting production, which only pushes those prices right back down. There's no reason to think that this time would be any different. It just might take a little bit longer because lots of corn's been taken offline in Ukraine. Long story short, Garner's adamant that the commodity bulls have gotten too complacent. This boom and bust cycle is inevitable, and the busts have already begun. Lumber's down more than 60% from its highs. Natural gas down 33% just since June. Oh, early June. Now that central banks around the world have declared war on inflation, that means they've declared war on commodity prices. You can try to fight them, but history says you'll lose. The chart, just interpreted by Carley Garner, suggests the recent commodities boom is not long for the world. She says we could still see some short-term upside, which is I'm betting with the oils, but long-term, she thinks this bull is about to get slaughtered. And when commodities turn against you, it tends to get real ugly real fast. But boy, will that ever give the Federal Reserve a genuine break. And maybe the stock market, too. Ben in Ohio. Ben.
Hey, Mr. Cramer. It's an honor to talk to you. I'm a huge fan.
Oh, thank you.
I'm one of the few Gen Z college students that's looking for value instead of meme stocks.
All right.
My company deals with mining commodities, which theoretically should be doing well during high inflation. However, this company is located in South America, exposing it to political instability, and there's always a chance that Jerome Powell will successfully shut down inflation. The company is Vale, V-A-L-E.
Okay, first, I'm glad you're listening. It's great. I am concerned. It's in Brazil. Brazil has become very hostile to capital. And so, therefore, I think the stock is just too risky to own. Let's go to Steve in California, please. Steve.
Hey, how you doing? I love your show.
Oh, thank you,
hey,
partner.
Jim.
What's going on?
Well, I'm cheating, and I need your help.
All right.
So I'm cheating because I've got two stock questions instead of one. One is CF Industries Holding. It's sort of like crypto going up and down. I'm wondering if it'll ever go into the hundreds again.
Right.
And the millionth question about Apple. What do you think?
Well, look, Apple, I say own it, don't trade it. But the problem here with CF Industries is this industry is boom bust. And when you have boom bust and it's been booming, you are going to get a bust in the fertilizers. No matter what you do, that is what happens because it costs very little money to get into that business. So let's say sell on that, and be aware that I disagree with Carley on oil because I think that there are reasons why we're not producing as much as I thought we would, but I understand why she would think that we could go back to 50 to 75. Tonight's chartist thinks the recent commodities boom is not long for the world. Time to get prepared because when commodities turn against you, it tends to get real ugly fast. There's too much complacency. Much more Mad Money Head, including my exclusive with Paychecks. After reporting a top and bottom line beat this morning, what did the street dislike so much in this quarter that drove today's selling? I'm going to talk to the CEO. Then, how negative is too negative? I'm putting the negativity into context and sharing if it's overdone. And of course, all your calls rapid fire in tonight's edition of the Lightning Round. So stay with Cramer.